All right, team, welcome to this new module where we'll explore the private side of the investment universe. You've probably already wrapped your head around stocks and bonds, but now we're entering the less polished, often more lucrative world of private equity and private debt. Now, here's the deal. Unlike public markets where everything's transparent and quoted every second on your screen, private capital operates in the shadows. Not in a sketchy way, but in a relationship-driven, high-stakes, wait-for-the-exit kind of way. And the payoff? It can be massive, but so can the risk. So what's on the table in this module? We're going to unpack what makes private equity and private debt tick. What kind of returns can investors expect? What kind of risks do they sign up for? How are these assets different from your plain vanilla mutual funds or ETFs? And yeah, how do you actually get your money out once you're in? We'll look at strategies like leverage buyouts, venture capital, and even some creative ways companies raise capital through PIPEs, private investment in public equity. And we'll also walk through exit strategies, like how private equity firms cash out and make their money. Spoiler alert, IPOs aren't always the end game. And don't worry, I'm not going to just throw technical jargon at you. We'll walk through each concept with relatable examples and break it down CFA style, so you know what to expect on exam day. By the way, if you're enjoying how clearly this is laid out, you've got the FinQuiz battle-ready summaries to thank. What you're seeing on screen is designed to help you visualize how these topics are linked together. And trust us, during crunch time, this kind of clarity is gold. FinQuiz also offers detailed Stanley Notes, formula sheets, mock exams, and a question bank that actually pushes you to think like a CFA exam writer. Hit the link in the video description to grab yours. So let's start. Time to pull back the curtain on how the private equity world really works. Now, when we talk about private capital, think of it as the money flowing to companies that don't trade on the big stock exchanges. This includes private equity, where firms invest in a company's ownership, and private debt, which is more about lending directly to those same kinds of firms, but off the public radar. Think of private capital funds as the behind-the-scenes players in the business world, the ones who don't hang out on stock exchanges or cozy up with traditional banks. These funds operate a bit like secret agents, swooping in with their own game plans to shake things up. Let's start with the equity side. There are a few big strategies that dominate this space: leveraged buyouts, LBOs, venture capital, VCs, and growth capital. Let's hit LBOs first. So what's an LBO? Imagine a private equity firm walks into a boardroom and says, hey, we like your company. We're going to buy you mostly with borrowed money and then make you leaner, meaner, and more profitable. Classic Wall Street move, right? Imagine a company like Dell back in the mid-2000s. Michael Dell teamed up with private equity firms, using a mix of borrowed money to buy out the company and take it private. It's like buying a fixer-upper house with a mortgage, renovating it, and then selling it for a profit. The idea is to use debt smartly to gain control and then improve the company's performance. And yeah, another classic example is KKR. Think about KKR snapping up Toys R Us years back. They used a ton of debt, made some operational shifts, but sometimes these deals work, sometimes they don't. That's the risk with leverage. Next, venture capital. This is the exciting, risk-taking cousin. Think of early investments in companies like Airbnb or Uber. VCs put money into startups that might seem like a wild gamble, but could turn into the next big thing. They're betting on innovation, new ideas, and potential explosive growth. Lastly, growth capital is for companies that have already made it past the startup phase, but want to take things to the next level. Imagine a company like Netflix a few years ago, already established, but needing funds to expand globally or develop new technology. Growth capital steps in to fuel that next phase of expansion. Now, there are two flavors of these buyouts. Management buyouts, MBOs, where the current team buys their own company with the help of private equity, and management buy-ins, MBIs, when a new team swoops in from the outside. Now, the idea behind these buyouts is simple: boost cash flows. You either increase sales, organic growth, cut costs, restructure operations, or go on an acquisition spree. But let's be honest, without cheap debt, most of these LBOs lose their edge. So when interest rates go up or credit dries up, like during the 2008 financial crisis, you'll see far fewer LBOs on the deal board. So folks, remember, in case of management buyout, the current management team of a company decides, hey, we know this business inside and out. Why not buy it ourselves? They team up, use some borrowed cash, and take control. It's like the crew steering the ship deciding to own the whole vessel. Management buy-in. This one's a little different. The buyers are outsiders who come in with fresh ideas and take over management. Think of it as a new captain stepping onto the ship, ready to chart a new course and shake things up. Now, moving to portfolio management. Private equity firms don't just invest in one company and call it a day. They usually manage multiple funds at the same time. Each fund holds a bunch of portfolio companies, kind of like a batting lineup. They monitor performance, sometimes replace management, and always keep their eyes on the exit door. And here's where it gets interesting: the difference between private and public equity. Both give you ownership and a say in how a company's run, but private equity often means holding a bigger piece of the pie. More control, more influence. But remember, whether it's private or public, equity investments come with their share of risk. It's a classic high-risk, high-reward game. You could back the next Amazon or Tesla, or face some serious bumps along the way. So folks, remember, both represent ownership, come with voting rights, and let you ride the wave of future profits. But private equity often means more control. That's because these firms usually take a bigger stake, sit on the board, and call the shots. Also, returns in private equity can be very different. Public equities can swing wildly based on quarterly earnings or Elon Musk's latest tweet. But private equity, it's more behind the scenes, with longer holding periods and fewer price updates. Still, equity, whether public or private, offers the chance to earn unlimited upside, but with a risk of total loss. Now, when it comes to how investors get involved, there are two basic routes: direct investment into a private equity fund, or an indirect route via a fund of funds. Think of a fund of funds like a master portfolio that holds stakes in multiple private funds, spreading out the risk and opportunity. Now, when you invest directly, you're picking specific assets yourself. Sometimes you even get to co-invest alongside a lead sponsor, kind of like joining forces with the expert driver in a race to boost your chances of winning. The direct route gives you more control, but usually requires big capital and serious expertise. The fund of funds option gives you diversification without having to bet the farm on one fund manager. And just like companies go through life stages, so do private equity opportunities. From seed stage, when it's just a pitch deck and a dream, to growth stage, when revenues are climbing, all the way to maturity or even decline, private equity plays look very different depending on where a company is in its journey. For example, when Uber was still just an idea, it got seed and VC funding. But once it became a global brand, late-stage private equity started showing up. They weren't looking for huge leaps anymore, just steady returns before the IPO window opened. Now, venture capital stages, that's our next stop. All right, so now that we've talked about how private equity works on the big picture level, let's zoom into one of its most exciting and riskiest corners: venture capital. This is where it all begins. Venture capitalists are basically the daredevils of the investment world. They pour money into companies that, frankly, might just be a PowerPoint deck and a passionate founder with a dream. But if they get it right, the payoff can be massive. Think early investors in Airbnb, Spotify, or Stripe. Now, venture capital comes in stages. These aren't just buzzwords, they reflect how the business grows and how investor needs shift along the way. So, first up, pre-seed, or what we sometimes call angel investing. This is literally friends, family, or a wealthy individual writing a small check to get a business idea off the napkin and into a pitch deck. No product, no team, just potential. Next, we move into the seed stage. Here, venture capital funds come in with a little more structure. The money goes toward building a prototype, doing market research, maybe getting the first few customers or beta users in the door. Still risky, but now there's a product or some early traction. And next is early stage financing, also called the startup stage. The product's built, but the company's not selling at scale yet. Capital is needed to fund operations, hire a team, and start growing. It's the let's prove this thing works phase. Think Series A or Series B funding rounds here. During these early stages, the original founders typically retain control of the company, and investors usually get either ordinary shares or convertible preferred shares. These shares give protection, especially if things go south, and the option to convert to common shares later if things go well. It's like a safety net and a rocket booster rolled into one. As the company grows, we hit the later stage financing phase. Now we're talking about real revenue, real customers, and an actual shot at going public. This is where the VC fund usually starts to gain more control, either through equity ownership, convertible debt, or a hybrid. Then comes the mezzanine stage. This is the bridge to the IPO. The company's mature, the product's proven, and the goal is to fine-tune operations and pump up growth just before ringing the bell at the stock exchange. This stage is all about prepping for the big exit. Now, folks, one important thing. Don't confuse mezzanine stage financing with mezzanine financing. The former is a timing stage. The latter is a financial instrument, like convertible bonds or preferred equity. That blends features of debt and equity. In mezzanine stage venture capital, the investment may include mezzanine instruments, but the main focus is getting ready to go public. And one thing that shows up a lot in these stages is convertible preferred shares. These are a favorite tool for VC funds. Why? Because they let you convert into common equity later, usually at a discount, while protecting your downside. If things don't go as planned, you get liquidation preference and can still share in the upside. It's a win-win if you structure it right. There's also something called minority equity investments or growth capital. Here, investors take a smaller, non-controlling stake in mature companies that want to expand, restructure, or make acquisitions. Management usually kicks off these deals to juice up earnings before going public, all while keeping control in their hands. Think of it as hiring a coach to get your game ready for the big championship. Now, what happens if you're a public company but still need a capital infusion and want to avoid all the red tape of a public offering? That's where PIPEs come in, private investments in public equity. Here's the deal with PIPEs. A publicly traded company issues shares or sometimes debt or preferred stock privately to institutional investors. This helps them raise cash quickly with fewer disclosures and often at a discount. A classic use case? Say a biotech firm has a promising drug in trial, but cash is running low. Instead of going to the public market with a full-on secondary offering, they cut a deal with a handful of hedge funds or private equity shops, offering them discounted shares. The investors get in cheap, the company gets funding fast. Everyone wins, kinda, but there's a downside too. These new investors dilute the existing shareholders' stakes. And if their interests aren't aligned with the company's long-term vision, you could end up with internal conflicts, boardroom tension, pressure to exit too soon, that kind of thing. So PIPEs are great in tough times, but they're not always shareholder friendly. All right, that wraps up our look into venture capital stages and PIPE deals. Now, let's head into exit strategies, the big payoff moment in the private equity life cycle. All right, let's get into one of the most important and honestly the most anticipated parts of private equity, the exit. Now, when private equity firms invest in companies, they don't plan on sticking around forever. They're not in it to grow old with the business. They're in it to build value and cash out at the right moment. Most of the time, they're aiming for a 5-year window, sometimes shorter, sometimes longer, but 5 years is the typical ballpark. So why is the exit strategy such a big deal? Because it's how PE firms monetize all the blood, sweat, and restructuring they put into these companies. Think of it like flipping a house. You renovate, improve the value, and then sell at a profit. Same concept, just with operating companies instead of real estate, but timing that sale is tricky. There are a lot of moving parts: industry cycles, economic conditions, interest rates, and of course, the company's own performance. If the company's thriving but the market is down, the exit might get pushed. Or if market valuations are peaking but the company still needs work, the firm might decide to bite the bullet and exit anyway. Now here's something candidates often trip up on: private equity versus public equity. In public equity, you're usually thinking long-term holding, dividends, price appreciation, passive exposure. But in private equity, it's all about value creation and then a timely exit. The firm comes in, takes control, improves operations, slims down costs, ramps up sales, whatever it takes, and then exits at a higher valuation than what they paid going in. And don't forget, these investments are usually staged. You might commit capital in year 1, deploy across years 2 and 3, and then exit sometime in years 4 to 6. So timing is everything. Let's talk about how these firms actually exit. There are 3 major routes: trade sale, public listing, IPO or SPAC, and then a mix of secondary sales, recapitalizations, and unfortunately write-offs if things go south. All right, first up, the trade sale. This is probably the cleanest and most straightforward exit strategy. Think of it like this: you've fixed up a company, made it leaner, meaner, and more profitable, and now you sell it to a strategic buyer, usually another business in the same industry. Maybe a competitor, maybe a supplier, or maybe a giant who's just looking to expand horizontally or vertically. This kind of sale can happen privately or through an auction-style process. Either way, the strategic buyer is usually willing to pay a premium because they're not just buying profits, they're buying synergies, cost savings, tech integration, distribution channels, you name it. Pros: it's fast, it's relatively private, and it can fetch a great price. Cons: fewer potential buyers. Regulatory approval can be a pain, and sometimes management or employees resist the sale, especially if there are job cuts on the horizon. Real world? Think Google acquiring a smaller AI startup. That's a trade sale. Next, the big one, going public. This is the one that makes headlines: IPOs. The company lists on a stock exchange and the PE firm sells its stake to the public. What's the appeal? You can often get a higher valuation. Investors love growth stories. Plus, it gives the company credibility, brand visibility, and access to even more capital. Now, going public also gives the PE firm flexibility. They don't have to sell their entire stake at once. They can gradually exit over time, especially if the stock price keeps climbing. But let's be real, it's expensive. Investment banks don't work for free, and the legal and compliance burden is huge. It's also risky. Markets fluctuate, and there's typically a lockup period after the IPO where the private equity firm can't sell its shares right away. For companies that want to skip the middlemen, there's also direct listing. It's cheaper, but you don't raise fresh capital. It's more suitable for firms that already have strong brand recognition and don't need the IPO marketing push. And then we have the SPAC route, kind of the trendier, flashier cousin of the IPO. A SPAC, or special purpose acquisition companies, is basically a shell company that raises money through an IPO with the goal of acquiring a private firm. Once it finds a target and merges, the private company becomes public without going through the traditional IPO process. The pitch? Less valuation uncertainty, faster path to liquidity, and often less hassle with the roadshow and marketing. Plus, big-name sponsors like Chamath or Bill Ackman bring buzz and investor confidence. But SPACs aren't a magic bullet. They come with higher dilution, more complex structures, and they're under increasing regulatory scrutiny. Oh, and let's not forget, when the lockup ends, a wave of selling can tank the share price. So while they're great for speed, they're not always great for long-term returns. Now, let's not forget the plan Bs. Sometimes PE firms will use recapitalization, basically refinancing the company with more debt, taking out a dividend but staying invested. It's a way to cash out some gains without a full exit. Or they might sell to another PE firm, a secondary sale, especially when there's still room to grow, but it doesn't fit their current portfolio goals. And then, there's the dreaded write-off. Sometimes a business just doesn't work out. Poor performance, industry collapse, fraud, you name it. In those cases, the firm may liquidate or walk away, taking the loss and moving on. So when do these exits happen? Well, most PE firms build in a 5-year investment period, followed by a so-called harvesting period. But honestly, the market sets the tone. You want to sell when valuations are high, not just because the calendar says it's year 5. And because committed capital is usually deployed over time, exits are also staggered. You might exit one company in year 3 and another in year 7. Private equity offers potentially higher returns than public equity thanks to hands-on involvement, operational improvements, and the use of leverage. But that comes with higher risk, especially around illiquidity, business failure, and valuation uncertainty. These exits, they're your payoff, but you've got to be strategic, flexible, and know when to pull the trigger. Now, folks, here's a reminder. The battle-ready summary you see on screen isn't just a colorful slide. It's a condensed, exam-focused review tool built for serious CFA candidates like you. These summaries help you cut through the noise and focus on what matters most on exam day. You can get the full set of FinQuiz battle-ready summaries in the link below this video. All right. Now that we've walked through private equity, let's talk about its lesser-known cousin, private debt. It might not get the same headlines, but in the real world of alternative investments, this one's pulling some serious weight. So what are we really talking about when we say private debt? At its core, private debt just means loans made directly by investors to private companies, rather than going through public markets or traditional banks. You're not buying a bond off the shelf, you're negotiating directly, usually with mid-sized or fast-growing companies that need cash but don't want to. or can't go the traditional route. Now, here's a little historical context. After the 2008 financial crisis, banks got hit with tighter regulations. They had to pull back on risky lending, especially to smaller or more leveraged companies. That left a massive funding gap. And guess who stepped in? That's right, private debt funds. These funds have since ballooned in size, offering tailored loans to businesses that are often overlooked by mainstream lenders. Let's break down the main types of private debt so you can see how the landscape is laid out. Private debt can be broadly categorized into 4 key types, each serving a different borrower profile and risk-return trade-off. Direct lending typically involves loans provided directly to middle market companies, often as an alternative to traditional bank financing. Mezzanine loans sit between senior debt and equity, offering higher yields in exchange for subordinated claims and sometimes equity kickers. Venture debt supports early-stage, high-growth startups, usually in conjunction with venture capital backing, providing funding without immediate dilution. Finally, distressed debt involves investing in the debt of companies in financial trouble, with the goal of profiting from turnaround or restructuring opportunities. When it comes to investing in private debt, you've got 2 options: direct investment, lend straight to the company. You negotiate terms, monitor performance, and hope for steady cash flow. Indirect investment. Put your money in a private debt fund that spreads your capital across multiple loans. That adds diversification, but you lose a bit of control. In both cases, lenders usually protect themselves with covenants, collateral, and legal agreements because, it's still credit risk. Now let's look at the toolkit of private debt financing. What options do these companies really have? First up, direct lending. This is your bread and butter private credit deal. A private firm lends to a mid-sized business, secured, scheduled payments, and strong legal protections. This space is getting crowded, with private credit funds now competing directly with banks. This is the simplest and most common form of private debt. Imagine a mid-market manufacturing company that wants to expand its production line but doesn't want to issue equity or take on public debt. A private debt fund steps in and offers a senior secured loan. It works a lot like a bank loan with interest payments and a maturity date, but it's all arranged privately. Because the lender is often taking more risk, no rating agency, no market to trade out of the position, they'll typically ask for higher interest rates and tighter covenants. These loans are often secured by company assets, and the terms are customized case by case. Then there's mezzanine debt. Think of it as the bridge between senior debt and equity. This type of financing is riskier than direct lending, but it gives the lender a shot at higher returns. So let's say a private equity firm is doing an LBO of a tech company. They use bank debt for most of the financing, but still need another layer of funding to close the deal. That's where mezzanine debt comes in. It fills the gap, often with equity-like upside through warrants or conversion features. This isn't just about earning a coupon. Mezz lenders want to ride the value growth too, but of course, if things go wrong, they're second in line after senior lenders. That's the trade-off: higher return potential, but higher risk too. Let's say a company's already tapped out on senior debt, but needs more cash. They take mezzanine financing, subordinated, yes, but with high interest and usually some upside potential. A mezz lender might get, say, 12% interest plus warrants. Now let's talk venture debt. You've got a startup. Maybe they just closed a Series B round. Their revenue is climbing, but they're still burning cash. They don't want to dilute existing shareholders with another equity round. So what do? They raise venture debt. It's short term, usually less than 3 years. and it's often paired with equity warrants to sweeten the deal for the lender. Companies like DoorDash, Uber, and Peloton used this strategy during their early growth stages. It allowed them to stretch their cash runway and hit key milestones before going back to equity markets. For investors, the appeal is participating in the upside of a high growth company, but with the downside protection of debt. Think of a small startup that just closed a Series A equity round, but still needs more runway. They take on venture debt to build out their product or expand into new markets. It's not cheap, but it helps founders avoid dilution. These deals sometimes include warrants or equity kickers for lenders to sweeten the deal. Next up is distressed debt. This one's more opportunistic and definitely not for beginners. Investors in this space buy debt from struggling companies, maybe a retail chain that's gone into Chapter 11, or an airline coming out of restructuring. The idea is that the market has priced the debt for disaster, but if you're able to turn the business around or restructure, there's massive upside. Firms like Oaktree Capital and Apollo made their names in this space. It's hands-on, legal-heavy, and high risk, but potentially high reward. You need serious expertise to navigate this world. A turnaround fund might step in to buy the deeply discounted debt of a struggling company. If the restructuring works, they can make multiples on their original investment. Think of how distressed investors swooped in during COVID, picking up cheap debt in travel and retail sectors. Then there's unitranche debt. This one's clever. Instead of layering different tranches of debt, senior mezz, etc., you bundle everything into one loan with a blended rate. It's simpler for the borrower and gives the lender more flexibility on structure. So, this is kind of a newer innovation that simplifies financing. Rather than slicing debt into senior and mezzanine tranches, you just have one single loan with a blended interest rate. For example, a private equity firm buying a healthcare group might use unitranche to avoid negotiating with multiple lenders. It's faster, cleaner, and gives the borrower a single point of contact. This is becoming increasingly popular in middle market buyouts. And finally, specialized loans. These are custom lending arrangements that don't fit into traditional categories. One example is litigation finance. A private debt firm might fund the legal costs for a company suing another party. If the case is won or settled, the firm takes a slice of the proceeds. It's niche, but potentially lucrative. All right, now let's take a minute to unpack the risk and return profile of private debt, because this is where a lot of exam questions like to sneak in, especially around investor expectations and portfolio suitability. So, first things first, why would anyone invest in private debt when you could just buy a government bond and chill? Well, it comes down to returns. Private debt offers higher returns than traditional bonds. And that's not just because investors are being generous. It's because they're taking on higher risk, mostly tied to illiquidity and complexity. See, unlike public bonds that you can trade with the click of a button, private debt is more like a relationship you commit. You're dealing with longer holding periods and way more hands-on engagement with the borrower. Now, about that risk profile, this is where things get nuanced. The risk isn't one size fits all. It varies dramatically depending on the borrower and the type of debt instrument you're holding. Lending to a stable real estate company is one thing. Lending to a distressed startup is a whole different ballgame. That's why this space requires specialized knowledge. You can't just plug numbers into a formula and hope it works. And here's another thing. Private debt is illiquid. That means you're not just investing and cashing out next week. These are often long-term relationship-driven deals. You're not flipping bonds, you're forming partnerships. Now let's talk about floating rates. Most private debt deals are not fixed rate like your classic treasury bond. Instead, they're pegged to reference rates, like SOFR, which adjusts with market interest rates. That means the income from these instruments tends to rise when rates go up. And right there, that's a key differentiator that makes private debt appealing in inflationary or rising rate environments. Another thing you'll often see is that private debt is collateralized. So even though the investor is taking on risk, they're not doing it blindly. The loan might be backed by real assets like real estate, receivables, or other secured property. So if things go wrong, there's something to claim. So who actually likes this stuff? Investors who are building fixed income portfolios often use private debt to boost yield without jumping fully into equity territory. It's also great for diversification because private debt behaves differently from both stocks and traditional bonds. It's not moving in perfect sync with the rest of your portfolio. And finally, private debt provides access to unique opportunities. You're not just buying into the same instruments everyone else is holding. You're investing in deals that are custom built, often negotiated one-on-one, and potentially much higher yielding than what's available in public markets. So bottom line, if you've got the patience, the expertise, or access to managers who do, and you're looking for strong yield with real asset backing, private debt can offer serious value. And if the CFA exam asks what makes private debt attractive or risky, you now know it's the combo of higher yield, floating rates, relationship-based lending, and the need for deep due diligence. Keep this slide in mind. It's a favorite testing ground. All right, let's wrap this up by talking about one of the most overlooked but absolutely critical angles when investing in private capital: diversification. Now look, when we're talking about diversification here, we're not just talking about holding different assets, we're talking about navigating different stages of the corporate life cycle, performance variability, and yes, timing too. So here's the deal. The performance of private debt and private equity doesn't behave like public market investments. It heavily depends on where the company is in its journey. Are we talking about a pre-revenue startup, a stable cash cow, or maybe a distressed business trying to survive another quarter? That's why you can't just throw private investments into a portfolio and hope for the best. You've got to think about vintage years, which is basically just a fancy term for the year a private capital fund begins deploying capital. It matters a lot because market conditions in that first year often shape the overall return potential. For example, a fund that started making deals in 2009, right after the financial crisis, probably snagged some bargains compared to one that launched during a market peak like 2021. So smart investors don't bet on just one vintage year. They spread their exposure across multiple vintage years to smooth out the risks and capture a broader range of return opportunities. Now let's talk risk-return trade-off, because this is where private capital really gives you options. You've got private equity on one end, highest return potential, but also the riskiest. Think venture capital or leverage buyouts. On the other end, you've got infrastructure debt, much safer and more predictable, but obviously lower yielding. Then in between, you have everything from junior and senior private debt to equity hybrids. So depending on your risk appetite, there's a spot for you in the private capital spectrum. Another thing, private capital doesn't behave exactly like public markets. The correlation with broad public indexes usually falls somewhere between 0.63 and 0.83. That means when your public stock portfolio is swinging with the market, your private capital exposure could offer a bit more stability or even move independently. That's a big deal for diversification. Of course, just like with anything in finance, there's no free lunch. The real gains in private capital usually come when skilled fund managers are at the helm. These folks have the experience, the networks, and the know-how to manage leverage, spot market inefficiencies, and navigate liquidity constraints. That's how they generate higher returns even when the risks are higher. Now, before we close out this module, let's bring it all together. Private capital, whether you're dealing with private equity or private debt, brings a whole new level of strategy to investing. It's not just about higher returns. It's about knowing when to enter, how to structure deals, understanding life cycles, and managing risk across different stages and instruments. And hey, if you've been following along with the battle-ready summary on screen, you already know how much easier it is to connect these ideas when they're presented clearly and visually. These summaries are purpose-built to help CFA candidates like you retain, revise, and recall key exam concepts, especially for complex topics like alternative investments. If you want the full set, including FinQuiz's Stanley Notes, formula sheets, question bank, and mock exams, go check the link in the description of this video. In the CFA exam, questions on this topic usually test your understanding of how private equity and private debt differ from public investments in terms of risk, return, valuation, liquidity, and exit strategies. You might get asked to identify the correct exit route in a scenario, compare private versus public capital characteristics, or choose which financing type is most appropriate at a certain business stage. It's all about grasping the big picture, why these investments behave differently, and how they fit into a diversified portfolio. And that's a wrap on alternative investment performance and returns. Nice job sticking with it. Now take a break, review the key concepts, and remember, when the CFA exam throws alternative investment questions at you, you're going to be ready.